Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about what's happening in the Chinese economy, and specifically to talk about bonds, currency, and the stock market, because there are some very worrying things happening in China right now. And the central bank has announced that it's halted its bond buying program. And this is obviously a major concern because the whole point about government bonds is that they're backed by the government. That's why people put money into them, because they're seen as a completely safe asset. If you take out a government bond, you know that you're going to be repaid 100% by the government. However, if the bond market dies, if the central bank stops buying, then obviously that throws the whole market into chaos. And the bond markets at the moment globally are a really interesting place. If you're following the channel, you'll know that I recently posted a video talking about the UK, because bond yields in the UK have hit a 26-year high. And the reason for that is because everybody's selling UK bonds. There's an inverse relationship between the price of a bond and the yield, because when a bond is issued, it has a fixed coupon. So if that fixed coupon is 5% and you buy a $100 bond, you're going to be paid $5 every single year whilst you hold that bond. Now, if the price of that bond goes down, if it drops by 50%, then you're still going to get paid your $5 coupon. But at that point, because the price of the bond has fallen by 50%, your yield would actually double to 10%. So that's how the inverse relationship works. When the price of bonds go down, yield goes up. And if the price of bonds go up, then the yield goes down. And in the UK, the reason why the yields have gone up is because everybody's selling. Everyone's concerned about what's happening in the UK economy. And so lots of fund managers are exiting from UK bonds, pushing the price down, because simple demand and supply theory tells you that when people are selling, the price goes down and therefore the yield goes up. But let's have a look at what's been happening in China. This chart shows the yield on Chinese government 30-year bonds over the past 5 years. And what you can see here is a very clear trend. In November 2020, the yield on Chinese government bonds was sitting at 3.94%. However, since that time, we have seen a consistent and steady fall in the yield, and the current level is sitting at 1.9%. And as we've just discussed, there is an inverse relationship between the yield and the price of a bond. So the fact that the yield on Chinese bonds has been falling over the past 4 years means that the price has been rising, and that indicates that demand for Chinese bonds has been increasing over the past 4 years. Now, instinctively, you might be surprised that the demand for Chinese bonds has been increasing in the past 4 years, because I've been talking about the economy being in difficulty for the last 3 years or so. So it's counterintuitive to think that people would want to buy bonds in China when the economy is in decline. However, the bond market in China is very different to the rest of the world, because access to Chinese government bonds is restricted. This table shows the breakdown of Chinese government bonds, which is split into 3 distinct markets. By far the biggest of these 3 markets is the onshore bond market that are denominated in Chinese yuan, and you can see that the total size of this market is the equivalent of 15.5 trillion US dollars. And this market is predominantly focused on Chinese buyers. The vast majority of overseas fund managers are not able to buy into this market. The second biggest market for Chinese government bonds is the offshore US dollar denominated bond market. And you can see that the total size of this market is around $600 billion, which is over 26 times smaller than the amount of bonds that are issued in China in Chinese yuan. And the third and smallest of all of the markets is the offshore bond market denominated in Chinese yuan, which equates to around 17 billion US dollars. So the reason why the market for Chinese government bonds is very different to the rest of the world is because the vast majority of the holders and the buyers are based in China. These are Chinese financial institutions who are buying lots and lots of Chinese bonds. And for those businesses, there's really only 2 options in terms of investing their money. Either they're investing into government bonds or they're investing into the stock market. So let's have a look at what's been happening to the Chinese stock markets. This chart shows the movement in the Chinese Composite Stock Market Index, which covers over 500 of the largest companies in China over the past 5 years. And what this shows is that the index hit a peak of 3,700 in September 2021. However, in the 3-year period through to September 2024, the index saw consistent falls. There were periods when the index bounced back up. You can see that there are sharp movements all the way along this chart, and they represent periods when the Chinese authorities instigated stimulus measures to try to boost the economy and boost the stock market. But as you can see, every single one of those resulted in a short-term gain and then long-term falls in the value of the index. Now, if you've been following the channel, you'll know that in September last year, the Chinese authorities announced one of the biggest stimulus packages that it had ever published, and this resulted in a stock market run. There was an increase of around 30% in share prices. There was a feeding frenzy. However, that was relatively short-lived. And as you can see from this graphic, the market is currently on the verge of entering a bear market. And a bear market is classified as when stocks fall by more than 20%. And you can see that since the high that was achieved at the start of November, we are very close to a 20% fall. And if the market does get classified as being in bear status, that tends to result in more sellers. People become very cautious if they know that a bear market has been called, and that can become self-fulfilling. As more people sell shares, share prices fall, and so the bear market starts to take hold. And we are on the verge of that happening right now. But if we jump back to the 5-year chart, the long-term decline in share prices in China is one of the reasons why fund managers have been buying bonds, which has been pushing the yields down. This chart shows the movement in the exchange rate between the US dollar and the Chinese yuan over the past 12 months. And what this shows is that since the end of September, there has been a sharp fall in the value of the yuan. And the current level that the currency is trading at is the lowest that's been seen at any point in the past 12 months. And once again, this is an interesting phenomenon because usually when bond prices are rising, that means that there is demand for those bonds, and usually the currency also appreciates in value. But because we've got this situation in China, whereby the vast majority of all of the bond purchasers are located in China, it isn't a global market, which means that there isn't a corresponding demand for yuan, and that's one of the reasons why the yuan hasn't been appreciating in value. And the reason why the yuan has actually been falling is because of what's going on in the Chinese economy. The fall in the value of the yuan represents the ongoing decline of the Chinese economy. So what's the summary and conclusion today? Well, I wanted to post this video because I think the news that the Chinese central bank has stopped buying Chinese government bonds is a really big news because this doesn't normally happen in a normal market. And the reason why the Chinese central bank has cited is because they're saying there is now a shortage of bonds in China. And the reason why there's a shortage is because Chinese financial institutions are desperate to put their money into a safe haven. They don't want to be investing into the stock market because the stock market over the past 4 years has been crashing. Now, we saw that there's been a bounce back over the past few months as a result of the fact that the Chinese authorities announced another stimulus package. But when you look at the history, when you look at what's happened following all of those other stimulus packages, there is a short-lived bounce and then the market starts to come down again. And we are starting to see that happen right now. I showed you the graphic that shows that the market is currently sitting on the brink of being an official bear market. And if that bear market is called, then we will see share prices starting to tumble in China over the next few months. And as we've discussed in today's video, what's happening in China is very different to what's happening around the rest of the world because we are seeing bonds being sold. Fund managers are exiting from bonds because they're worried about what's going on in the global economy. A lot of economies are sitting at a turning point. We could see a sharp recession at some point during 2025. And I think Donald Trump taking over as US president is causing major concerns because he's running around saying to everybody that he's going to increase their tariffs. And if he does that, then that's going to have a massive impact on global trade, will reduce the amount of profit that companies around the world are making, and could result in a fall in profitability and a fall in the economies of all of those different countries. So there's a lot of uncertainty right now. But in China, the opposite is going on because Chinese fund managers are panicking about what's happening in the economy. The economy is continuing to slow down. We've got major concerns about whether or not China will hit its 5% growth target for 2025. And if it doesn't, then that means that the share prices of Chinese companies are likely to keep coming down. Fund managers don't want to put their money into the stock market if it's going to tumble, and so they're desperate to take on more and more Chinese government bonds because they know that the Chinese authorities will pay them back. They're guaranteed to get their capital, so there's no risk to that. But the problem we've got right now is that Chinese bonds are in short supply. Everybody wants to buy them, and therefore yields are at a very low level. And that is totally different to what's happening around the rest of the world. And the reason why all of this is happening is because the Chinese economy is still in a very dire situation. And the overall summary of today's video is that the reason why all of these things are happening in China is because the Chinese economy is still struggling. It's getting worse. We're seeing more and more data coming out that tell us that the economy is slowing down. And if Donald Trump does apply more tariffs against China, that's likely to have a further detrimental impact. And overall, China is now sitting at a turning point. This could be the start of a major slump starting in 2025. Now, hopefully you found today's video useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.